Think about this for a second. एक कंपनी जिसे आप रोज यूज करते हो, maybe you order food from it, maybe you travel using its services, या फिर you buy its products almost every month. One day, suddenly headlines flash everywhere. This company is coming out with its IPO. Social media explodes, financial news channels can't stop talking, and your friends in office are like, "ये IPO miss मत करना, allotment तो लेना ही है." But then, as you start reading more, you come across words like price band, DRHP, book building, oversubscription, and anchor investors. And you're like, okay, but ये सब क्या है? Should I even care about all of this? Well, in this masterclass, we will decode all these jargons. Let's start with the basics very briefly. IPO stands for Initial Public Offering. Why do they do this? The simple answer to this is to raise money. A company needs funds to expand, to pay off its loans, to strengthen its brand, or maybe to reward early investors by giving them an exit. So instead of only taking loans from banks or borrowing privately, they say, let's open the doors to the public. And now that you know the essence of IPO, let's jump to today's session, the jargon. Because IPO के आसपास जो भी jargons use होते हैं, वही decide करते हैं कि investors को कितनी clarity है और कितना confusion. Let's start with the big one, DRHP. You'll hear this in almost every IPO conversation. Draft Red Herring Prospectus. Sounds complicated, right? But it's nothing fancy. DRHP is basically the company's official CV. A big document where the company says, here's who we are, here's how much we earn, here's our business model, here are the risks, and here's why we need money. For example, imagine company A, a tech startup, is filing for IPO. In its DRHP, you'll find details like revenue from the past 3 years, net profit or losses, how much debt it carries, what its strengths are, and what challenges it faces. Even how the money raised from IPO will be used. Expansion, debt repayment, or maybe opening new factories. As an investor, if you read DRHP carefully, you already get a good idea of whether this company is worth your trust or not. Yes, the document is long and a bit boring, but it's the single most transparent source of truth. एक investor के लिए ये compulsory reading होनी चाहिए. Now let's move to the most exciting part, price discovery. You'll often hear terms like book building and price band, but what do they mean? Book building is the process through which the final IPO price is decided. Instead of fixing one number, the company and its bankers give a range, let's say 200 to 210 rupees. This range is called the price band. Investors place their bids within this band. If most bids come at 210 rupees, chances are the final issue price will get fixed at the top end. If bids are spread out, maybe somewhere in the middle. The point is, book building reflects demand. More the demand, higher the price. So the price you finally get allotted is not random. It's based on collective bidding. Imagine it like an auction, but a more structured one. Next jargon is lot size. When you hear lot size of 50 shares, it simply means you cannot apply for just one share. The minimum you can apply for is 50. So if the price band is 200 rupees per share, one lot is equal to 10,000 rupees. This ensures that investors put a reasonable amount of money and not everyone just throws 200 rupees for one share. It standardizes the process. And if you want to invest more, you apply in multiples of the lot. The next jargon is a very important one. IPO investors are divided into categories. Retail investors, that's you and me, can apply up to 2 lakh rupees. Then we have HNIs, high net worth individuals, who can apply above 2 lakh rupees. And then QIBs, qualified institutional buyers, mutual funds, insurance companies, big financial institutions. But why this division? Because the company doesn't want only retail or institutions. It wants a healthy mix. Generally, around 35% of the shares are reserved for retail, 15% for HNIs, and 50% for QIBs. सोच के देखो. This balance makes sure that the big players as well as the small investors both get space in the IPO. Now comes one of the most hyped terms, oversubscription. If an IPO offers 1 crore shares and investors apply for 10 crore shares, that's 10x oversubscription. People get super excited when they see these numbers. It creates FOMO. But what it also means is allotment becomes very tough. On the flip side, if the IPO doesn't get enough demand, say only 70 lakh shares applied against 1 crore offered, that's undersubscription. And in extreme cases, IPOs can even get cancelled. So oversubscription shows hype, but for retail investors, it often translates into a lottery system. Your application may or may not get shares, depending upon luck. After the subscription window closes, comes the allotment. If the IPO is oversubscribed, shares are allotted via a computerized lottery. Some get lucky, some don't. If you don't get allotted, your money is refunded automatically to your bank. It's important to note, not getting shares doesn't mean you did anything wrong. It's just the math of demand versus supply. Finally, the big day, listing day. The company's shares start trading on NSE and BSE. If the demand is high, you may see the stock open much above the issue price. That's called a positive listing. People who get allotment can book quick profits known as listing gains. But sometimes IPOs list below the issue price too, a negative listing. And that's when you realize hype doesn't always equal to profit. The long-term story always depends on business fundamentals. One more important jargon you'll often hear is fresh issue versus offer for sale. Fresh issue means the company is creating new shares and raising fresh capital, which will be used for growth, expansion, and etc. Offer for sale means existing investors, which are promoters and early backers. These people are selling their shares to the public. In this case, the money doesn't go to the company. It goes to the selling investors. So as an investor, it's useful to know, is your money helping the company grow or is it just giving an exit to old investors? Now, before we close, let's also talk about the mistakes. बहुत लोग सिर्फ hype देख के apply कर देते हैं. They look at GMP or hear from a friend that this will double on listing day and they blindly apply. But the smart way is to check fundamentals in the DRHP, compare valuations with peers, and most importantly, know your own risk capacity. Remember, an IPO is not a lottery ticket. It's an entry into a business. Short-term gains are attractive, but long-term returns depend only on how strong that business really is. So the next time you hear, "Arey IPO आने वाला है, apply करें या नहीं?" you won't be lost in jargon. IPO investing is not about chasing the hype. It's about decoding the story behind the numbers. और वही आपको edge देता है as an informed investor. That's all in this masterclass. Please do not forget to like, share, and subscribe for more such financial insights. See you in the next one.
Investments in the securities market are subject to market risk. Read all related documents carefully before investing.